Hey everyone, I'm Ryan and welcome to the very first video on our channel. Today we're taking our first step into understanding financial markets. But what are financial markets exactly? What gets traded there and why should any of this matter to us? Whether you're completely new to this or already have some experience, this video will help you gain a solid overview of the different types of markets and how they work. By the end, you'll have a clearer sense of where to start if you're interested in investing. So stay with me for the rest of the video and let's dive into the world of financial markets together. The first market we'll explore is the stock market. This is where companies sell shares to raise capital and investors buy those shares to own a small piece of the company. Think of it as owning a piece of a large, successful business. When the company grows and becomes more valuable, your shares appreciate in value too, potentially yielding profits if you decide to sell them at a higher price than you paid. But how do people decide which stocks to buy? Investors use different strategies. Some rely on fundamental analysis, looking at a company's financial health, like its revenue, profit, business strategy, and even industry position. If a company has strong revenue growth, low debt, and a competitive product, these factors often suggest long-term growth potential. Another popular approach is technical analysis. Here, investors study historical price patterns and trends to predict future price movements. For example, if a stock's price has consistently risen after hitting a certain level, some traders may anticipate a similar rise when it reaches that level again. Let's go over a few examples to clarify. Suppose a technology company releases a new smartphone that everyone loves. This demand surge could drive up the company's revenue and ultimately the stock price. But on the other hand, if that same company faces obstacles, say supply chain issues that limit production or fierce competition from another tech brand, its stock price could drop. Investors need to weigh both the company's potential for growth and the risks it faces. Stock markets operate on major exchanges, such as the New York Stock Exchange, NYSE, and the NASDAQ in the US, as well as regional ones like the Tokyo Stock Exchange in Japan. Each of these exchanges has specific rules for listing companies, and many investors view these exchanges as indicators of a company's reliability and stability. Investing in the stock market is popular for building wealth over time, but it requires patience and an understanding of the risks. Stocks can be volatile, with prices changing due to economic events, political news, or even public sentiment. For example, during an economic recession, stock prices generally fall as investors worry about reduced corporate earnings. Conversely, in times of economic growth, stocks can rally as companies generate more profits and expand. Additionally, there are different types of stocks, such as growth stocks and dividend stocks. Growth stocks belong to companies expected to grow faster than the average market. These stocks may not pay dividends, but can appreciate significantly over time. Dividend stocks, on the other hand, provide regular income to shareholders through dividends, making them appealing for investors looking for stable cash flow. So, while stock markets can be a great way to build wealth, it's crucial to keep in mind the volatility and risks involved. Many investors diversify their portfolios, spreading their investments across different sectors and types of stocks to manage risk effectively. By balancing growth opportunities with stability, you can create a portfolio that matches your financial goals and risk tolerance. Moving on to the Forex market, or foreign exchange market, where currencies from different countries are traded. The Forex market is massive, with trillions of dollars traded every day. The main participants here include large banks, central banks, corporations, and individual traders. In Forex, we often deal with currency pairs like EUR USD or USD JPY. When you trade a pair, you're essentially betting on one currency strengthening against the other. If you believe the euro will strengthen against the dollar, You would buy EUR USD. If correct, you make a profit. If not, you take a loss. A country's interest rates play a major role in this market. For instance, if the European Central Bank raises rates, the euro may become more attractive, leading to a rise in its value. Conversely, if there's uncertainty like economic instability or political changes, the currency could lose value. For Forex trading, many people use leverage, which can amplify both profits and losses. This makes Forex a high-risk market, best suited to those who understand the risks and strategies involved. Next up is the commodities market. Here, raw materials and resources like gold, oil, wheat, and coffee are traded. Commodities are essential to the global economy, as they provide the building blocks for industries and everyday products. Commodities are often divided into two categories: hard commodities and soft commodities. Hard commodities include things like gold and oil, which are mined or extracted. Soft commodities are agricultural products like coffee, sugar, and corn. Investing in commodities is popular as a hedge against inflation. When prices of goods rise, commodity prices can also increase, helping protect investors' purchasing power. For example, gold often goes up during economic uncertainty, as investors see it as a safe haven. But commodity prices are influenced by unique factors. For example, political tensions in oil-producing regions can affect oil prices, or weather conditions can impact crop yields, affecting prices of grains and other soft commodities. Finally, we have the cryptocurrency market, one of the most rapidly growing and talked about markets today. Cryptocurrencies, like Bitcoin and Ethereum, operate on decentralized platforms using blockchain technology, which enables transparent and secure transactions. Unlike traditional markets, crypto is known for its extreme volatility. For instance, Bitcoin's price can rise or fall dramatically within hours, which makes it exciting yet risky for investors. Many see cryptocurrency as the future of finance, while others view it as highly speculative. Within the crypto market, we have different types of coins: mainstream coins like Bitcoin and Ethereum, and altcoins, alternative coins that each have their own technologies and purposes. Some altcoins are used for decentralized applications, while others focus on privacy or speed. Investing in crypto requires a thorough understanding of the underlying technology, as well as the ability to handle market fluctuations. Since the market operates 24/7, it's also different from traditional markets, where trading is limited to certain hours. So, I hope this video has given you a clearer view of what financial markets are and how they work. Whether you're drawn to the stock market for its growth potential, the Forex market for its excitement, the commodities market as an inflation hedge, or the cryptocurrency market for innovation, there's something for everyone. The important thing is to start by educating yourself and to always consider the risks involved. Each market has its unique challenges, and understanding these can help you make better, more informed investment decisions. If you found this video helpful, please consider liking, subscribing, and leaving a comment. I'd love to hear your thoughts, questions, or suggestions for future videos. Thanks for watching, and until next time, stay wise with your investments and take care.